Hello, my name is True Demon, and I'm the Devil's Stockbroker. Thank you so much for tuning in to watch this video. Before we begin, please understand I'm not a financial advisor, and none of the following content is financial advice. The following content is for educational and entertainment purposes only. Trading stock carries inherent risk, and you should always respect and understand your own personal risks when considering any investment. Please don't take what I say as gospel, and please do not trade based on the information that I receive and share through my content. Thank you so much, and have a hell of a time in the stock market. Hello everybody, my name is True Demon and I'm the Devil's Stockbroker. This video is going to cover a little bit of technical analysis for GameStop and AMC, but what I mainly want to focus on is something referred to as the derivatives time bomb, a concept that was introduced by Warren Buffett when he saw just how over-leveraged our banking system was and the fact that our entire nation's economy is propped up on debt. This is the exact situation that has brought our economy to its knees before in the past many times between the Great Depression, beginning with the stock market crash of 1929, again in 2008 with the global financial crisis, and now, just less than 20 years later, we are about to go into yet a third, and I believe what might be the final nail in the coffin. Before we go forward, I would ask you that you please like the video and share it with everybody that you can think of, social media, friends, family, and anybody else who will listen if you agree with what I'm saying and what I have to share in this video. I am sorry to say that it's not going to be the most uplifting thing that you hear about the stock market, but it is necessary that everybody has a very full, clear, and honest picture of what's about to happen. So without further ado, let's get into it. The first ticker that we're going to be covering is AMC. AMC, as you know, has been the topic of much debate and one of the two main short squeeze candidates for the quote MOAS. Between AMC and GameStop, these are the two most significant large cap companies which are currently traded on the stock exchange, which are the most over leveraged on the short side. Between AMC and GameStop, both have a short interest of greater than 20% of their free float, but there are some other consistencies between themselves and other short squeeze plays, which I'm going to point out thanks to our partner Ortex, who's provided us with a great deal of insight through short liquidity and shorting data to tell us a story of exactly how market makers, institutions, hedge funds, and banks work together in order to provide this liquidity to allow such over-shorting and over-leveraging to take place. And this is going to tie into this topic that we're going to be getting in later on in the video regarding the derivatives time bomb. So AMC closed the day at $12.50. It's come down a long way from its squeeze height of over $70, which it reached its peak on June the 2nd of 2021. Those of you who have been following my channel for a while may have seen this timeline, which you see here, which breaks up the different squeeze timelines from the first squeeze to the second, and then adds upon it a Fibonacci-based scale to stretch out the timeline in order to make a guesstimation of when the next squeeze might take place. However, we are rapidly approaching the final section that I would say leaves this to be a plausible theory. After this week, I would say that this theory no longer holds any water. So, of course, my fingers are crossed, but I'm not holding my breath. Zooming in on the chart, what we can see is that the extended moving averages have slowly been getting tighter and tighter and tighter together as AMC is consolidated down at what was previously a major breakout point during the initial squeeze to $70 at $12.50. AMC thus far has refused to stay below the $10 watermark, which it broke out of back in early May of 2021. Since then, we've been in this consolidation phase after the squeeze took place, and I would say that it was largely due to a combination of shorts covering and gamma, though mainly I would say it has to do with gamma. There's a couple of other data points which I can point to that would indicate that a squeeze is approaching AMC, but we can't say for certain because the only thing that requires a short to be closed out of their position is either A, their own decision to do so, or B, their broker's decision to close out their account because they're unable to meet margin requirements. On the technical side, we can see that AMC had multiple crosses of the extended moving average, or the exponential moving average, of the 20 and the 50 here in the red and the orange. It crossed up during our run up to $35 and then crossed back down shortly thereafter once it relaxed. Since then, AMC has created a double bottom pattern, which is known to be extremely bullish, but never broke out of the top at $16. It's since consolidated down, at which point on the hourly time frame we can see that it's creating more and more bullish signals. In particular, we see multiple bullish divergences appearing on the RSI, the same signal that would have kicked us off in late May of this year, right before AMC ran to 25. We're still currently waiting for one more move, but we can see that AMC has been consolidating in this wedge pattern. This symmetrical triangle, which AMC has formed over the last several weeks, is the most current bullish indicator that we can show on the long-term time frame. Other than that, all we have are just long-term lagging indicators such as the extended period moving averages and the OBV. As you can see on the OBV chart at the bottom of your screen, what you'll notice is that AMC has continuously created moving and lifting plateaus every time the price hit a new all-time high. The volume of AMC slowed down, and despite the lower price action, the volume wasn't enough to push the overall OBV profile down. This is something that's known as OBV bullish divergence, or OBV plateauing, which is something that I've talked about several times. Ordinarily, OBV plateauing indicates that there are more buyers than sellers, and that the sellers, which are causing downward price action, are doing so through lower volume periods, and they're able to therefore push the price down. But overall, shareholders have not been selling off, contrary to what mainstream media keeps telling us. What this indicates is that people are still holding onto the stock no matter what happens. And what we can infer from this data is that algorithms continue to sell off AMC. Recently, however, we've had a significant change. What's changed in AMC's behavior is the fact that the OBV has completely stalled out in its descension, meaning that it continuously moves up even as the price action moves down or consolidates sideways. After AMC made its grand move upward and then immediately sold off, we saw that it took only a single week for AMC to reach this new high, but it took 4 weeks for it to push it all the way back down to the $12.50 mark that we're currently sitting at, and it consolidated from there. Right now, AMC's volume is still at its lowest point, going into a time period where we're anticipating major news of box office gross profits and a whole bunch of good news from the movie theater industry, proving that once and for all, movie theaters are in fact here to stay, and AMC is still among one of the most profitable theater chains in the entire country. If we contrast with GameStop, you'll notice that GameStop's plateau has only ever had one single level. No matter what happened to GameStop, it has maintained this long tail on its OBV, no matter how low they got the price. And throughout the entire last year, GameStop has had multiple ups and downs, but has more or less maintained its level and never dropped below $80 level. Not at least since February of 2021. What we can infer from this is that while both stocks have been heavily targeted by algorithms from institutions, they've held up in their price action because there's simply just a lack of shares available and also a lack of retail selling, which is the entire fuel that causes panic in the market. Volume caused by retail sell-offs is what allows institutions to accumulate mass shares, and the fact that it's not happening continues to be proven by all of the data that's presented within the market. And despite what mainstream media would keep telling us, Nobody is selling either of these stocks. The only ones who are institutions, which are majorly over-leveraged. Moving over to Ortex, we can see that there's some very clear trends in front of us, which I feel is even further catalyzing a short squeeze. Right now, AMC, ever since February 8th, 2022, has been fully maxed out utilization on all short shares. That means every single share which was provided to shorts from this point on has been extremely hard to borrow. What this tells us is that shorts are having to go and ask for additional shares from other places in order to provide more shares to short. Where do they go for this? Prime brokers, market makers. Those are the two locations where they can get inventory of shares, and they can also generate naked shorts through either short exempts, which are afforded only to market makers during, quote, legitimate market making activities. That doesn't necessarily mean that it's legitimate, though, does it? One thing that we can use to tell ourselves and confirm whether market makers are messing with a stock is if we look and compare the short interest versus the on-loan shares. What we can see here is that AMC's on-loan shares versus its short interest is actually separated by more than 40 million shares by May 12th of this year. As we go further, all the way up until June the 8th, the short interest has climbed to 121.8 million, but on loan is 185 million. This is a difference of more than 64 million shares in total. If we extend out even further, we see that the short interest actually went slightly down, but the on loan shares continued to climb up to 193 million. Currently, we're sitting at a difference of more than 74 million shares between what is on loan versus what is actually being reported as short interest. So what are all those other shares doing? Let me tell you. Those other shares are being used by market makers because they haven't actually found any shares within the market to cover their short position, which they created by offering synthetics. Market makers which are trying to make a market, or at least are trying to assist in pushing a stock in a downward direction, are most likely providing short exempts in order to, one, cut off retail buying and taking those transactions off to a dark pool exchange. However, in order for those transactions to actually be filled in a dark pool, the shares have to be offered in a dark pool in order to be transacted, brought to the market maker's inventory, and then used to cover shares purchased by retail. If that doesn't happen, then what the market maker must do is they must borrow shares from elsewhere, and they must hold it on their books as a short position until a time when they can actually cover the stock. Typically, when market makers are doing this, you can see evidence through the short exempt data. Here what I'm showing you is the actual short exempt volume data courtesy of Ortex, which is reported by FINRA every single day at the end of the trading day. Ortex has compiled this data into a chart which we can actually see the historic short exempt volume on the exchanges as reported by FINRA, and we can relate this to days of significance on AMC stock. As you can see, short exempts were extremely low, as they should be during normal trading conditions. Back in early January, they started to get very unusually high, spiking over 170,000 shares short exempted. During the actual squeeze, short exempt volume actually got to a monumentally mind-blowing high of 15.37 million shares sold as short exempt. These short exempt shares are used, as I said, by market makers in order to intercept retail purchase orders, in order to cover their purchases, make the market, and then they supply the shares at a later date, because short exempts do not need to be located or delivered until 6 trading days after the fact. Plenty of time for market makers to figure out some way to cook up a bunch of shares, borrow them from another location in order to meet their delivery requirements, while they push the stock down and then cover at a lower price. The same exact thing started to happen in April and May of 2021, when the short exempt volume was still exorbitantly high throughout all of those months, and all of the short exempt volume started to spike ridiculously high during the week of May 10th and onward, as the price continued to lift against shorts and the market makers, pushing more and more call options deep into the money and forcing market makers to delta hedge their options in order to cover stock. This inevitably led to the massive squeeze during which market makers again had to turn to short exempts in order to continuously cover retail purchases on and on and on. As we see time has gone on, the short exempts have slowly tapered off, but they have always returned to this all-time low, and they've never, ever, ever been reasonably low. At all times, short exempt volume has been extremely high on AMC, and the same can be said for GameStop. GameStop, as you can see, which has been fully utilized since February 14th of 2022, while it was trading at a price of around $120. As well, the short interest and the shares on loan have been separated by at least 5 million shares ever since that date. And they continue to be separated. And in fact, the on-loan shares continue to climb over time as short interest slowly tries to catch up. As I said before, this is indication that market makers are the ones that are holding these shares on loan, and they are the ones who are over-leveraged and stuck in this situation. Just as with AMC, GameStop also had the same situation, where short exempts were becoming ridiculous going into December as retail continued buying and holding the stock until eventually the shorts were squeezed out of their positions. Market makers continuously had to step in the middle using short exempts because they couldn't locate enough shares because there weren't any. And obviously, the stock continued to climb to ridiculous heights while short exempts were used to continuously kick the can down the road, and market makers were allowed to continue to do so throughout the entire mania that swept up GameStop, AMC, and other meme stocks. To date, we still haven't quite returned to a norm, but short exempt volume has clearly fallen off a cliff, and we are experiencing extreme lows in the amount of short exempts despite the continued interest in GameStop and AMC. So I can hear you all asking me simultaneously, True Demon, why the hell do I care about this, and what the fuck does it even mean? So this brings me back to the original point of this video, which refers to, or which is known as, the Great Derivatives Time Bomb. This is a concept that was talked about and mentioned multiple times by famous investor Warren Buffett, who referred to derivatives as a time bomb within the market waiting to explode. What he was referring to was the fact that our banking system is structured, and in fact our entire stock market is structured so that derivatives can be used in order to create leverage within the stock market and allow people to profit through things like options, leveraged ETFs, swaps, and other complex investing instruments which are used to allow investors greater returns in return for higher risk. The problem that this creates is when there is a situation where there is no equilibrium in the market, somebody has to take on all of that leverage, and there has to be some collateral for all of this risk. When there is a situation where any particular device or instrument goes to extreme overvaluation or extreme lows and undervaluation, somebody is inevitably left holding the bag. So who's left holding the bag in the case of naked shorts when there is a situation where some organization has created synthetic shares or, naked shorts or whatever you want to call them? Who is holding on to that risk? Well, as it turns out, it's the fucking banks. Before I continue any further, I want to give a huge shout out to Short the VIX, who, through his due diligence, I was able to find this information, and I'm so thankful for him and his hard work in finding this and being able to explain it. It sent me down a very long and dark rabbit hole of where the hell we're heading in this frickin' economy, which is about ready to go and throw itself off of a cliff. What you're looking at here is BIS.org's statistics on OTC derivatives in their notional outstanding value by risk category. What that essentially means is over-the-counter derivatives, think options, calls, or puts, and their notional or intrinsic value at the time that they were purchased. And this is the amount outstanding in dollars. In total, all risk categories, there are over 598 trillion US dollars in existence through OTC derivatives. To illustrate to you just how mind-boggling and monumental this number is, I have to go back and describe to you the actual economic value of our economy. Allow me to very briefly introduce you to the U.S. national debt clock, which is currently counting up at over $30.5 trillion USD. Our current gross domestic product, which is only worth about 23.5 trillion USD, is remarkably lagging behind our total debt. What this essentially translates to is that the United States owes far more than it's producing, and at this point, it's pretty safe to say that the United States is never going to pay back its fucking debt. So, we are officially a debt society, and this is entirely how our economy works. Our debt is just passed off onto somebody else, who then sells that debt to somebody else, who sells that debt to somebody else. And on and on and on the carousel of insanity goes in perpetuity until eventually shit just blows up and the entire US dollar goes to fucking zero. And to illustrate just how far reaching this $600 trillion figure is, know that the total stimulus that we spent for the 2019 COVID-19 crisis, which is a total of $10 trillion, is already triple what the entire stimulus for the 2008 global financial crisis was that we paid out in order to dig ourselves out of that, by of course leveraging ourselves with more fucking debt. And who paid for all of that money? Who else but the good old Federal Reserve Bank? The Federal Reserve, which is entirely responsible for managing our supremely fucked up economy, is basically propping up our entire country's wealth with creating more dollars, just printing them, and in addition, buying assets out of the market in order to inflate and prop up their value on toothpicks. Back in 2008, when the crisis hit the worst of it, the Fed's balance sheet climbed to a ridiculous $2 trillion in order to pay for all of the banks that completely fucked up and threw themselves into a bunch of derivatives called consolidated debt obligations and credit default swaps that they didn't understand and had no idea how they could possibly go wrong, even though they were built upon fraud. Since then, the balance sheet has only seemed to balloon to ridiculous levels until we eventually started to pay it off, starting in 2014, which led to an economic downturn going into 2018, even further being precipitated by the Fed further decreasing the balance sheet in 2018, which we all remember was a terrible time for our economy. And we were sure that the Fed was going to send us into another recession. Lo and behold, it didn't. But starting in April of 2021, when COVID hit us, the Fed started to just buy up fucking everything. They printed out a whole bunch of dollars, sent everybody checks, and they bought assets, especially mortgage-backed securities, out of the stock market in order to prop up our nation's floundering economy in the wake of a massive pandemic disaster. While we appreciate their efforts to go and throw themselves on a grenade for us, what they actually did was kick the grenade up into the air, and now we're all going to get a taste of the shrapnel. The Fed now has to be put in this position where inflation is entirely out of control, climbing up past 8.5%, and now we're talking about numbers like 9%, which are dangerously close, flirting with hyperinflation, which starts to kick in somewhere at 18 to 20%. Right now, the Fed's balance sheet is the highest that it has ever been historically, and only now are they talking about unrolling it at a time where they literally have no other choice. And they are doing not just quantitative tightening by unrolling the balance sheet and continuing to sell assets, which is inevitably going to cause the stock market to crash. They are also going to be tightening up all of the money printing. They are also going to be refusing to take more and more reverse repurchase agreements, or reverse repo. Reverse repo agreements are slightly different, but it means somewhat the same thing. But there is a very interesting piece of information that I want everybody to understand about repurchase agreements. What reverse repurchase agreements are is essentially a transaction between all of the major banks within the United States in order to deposit funds to the Federal Reserve overnight. The reason why they do this is because banks, in order to meet regulations, must accept that holding on to a certain amount of cash is not acceptable and is an unnecessary risk. So, on days when banks are completely flush with cash or when they have clients, such as other banks, hedge funds, and institutions, which are made up of investment firms, are holding on to an extreme amount of cash and or leverage, they must deposit it to the Fed in order to meet regulations. If a bank deems that it is holding on to extremely risky assets, or if it is holding on to investments on behalf of one of its clients that are deemed extremely risky, these banks must post collateral and deposit it overnight. Since 2001, at a time when the stock market has absolutely gone stupidly bananas, the Fed has been doing more than 700 billion, 800, 900, 1 trillion. No. Even more than that. To the latest figure of overnight repurchase agreements was more than 2.2 trillion just last Friday. Now, these are nightly transactions. Nightly. These transactions in this amount, this 2.2 trillion that was transacted all at once Friday night. This is the amount of transactions that are happening every single night. This is evidence of over leveraging. And this is something that everybody in retail and everybody invested in the stock market needs to understand in order to get this through your head, because what this means is that the banks are way over leveraged. And in order to demonstrate and provide evidence of this overwhelming stupidity, I give you the quarterly report of the Office of the Comptroller of the Currency, the OCC.gov. What this report contains is a quarterly statistic and track record of the total amount of assets and derivatives of bank trading, particularly as it pertains to derivatives which include insurance contracts, options contracts, swaps, T-bonds, and any other form of leverage that you can think of. Most of the data that's contained within this report is pretty mundane. As it reads, insured U.S. commercial banks and savings associations are dealing in roughly $7.5 billion in trading revenue per quarter. And that's just a 3 months business track record for them. But what I find more interesting in this report is not so much what their quarterly metrics are, but rather what their entire total balance sheet for risk is at the very end of the report. Here on page 18, we see the notional amounts of derivatives contracts which exist for the top 25 banks in the entire United States. Ladies and gentlemen, I give you the 5 most over-leveraged and stupid financial institutions within our 4 borders. JP Morgan Chase, Goldman Sachs, Citibank National, Bank of America, and Wells Fargo. These institutions, in combined total between the 5 of them, are holding on to more than $167 trillion in derivatives risk. That is out of a sum total of $176.4 trillion of risk. If you're not so great with math, let me do it for you. That is a combined total 94.79% of the total derivatives risk in the entire economy. $176 trillion of risk held within 5 banking institutions, all within the United States. This number is so mind-bogglingly large because the total balance sheet for the Fed is only currently $8.9 trillion. These motherfuckers are over-leveraged more than 19 and a half times the entire Fed's balance sheet. Understand that if this entire institution, any one of these institutions went tits up, if any one of them fucked up badly enough that they could not cover their derivatives risk, the entire Fed's balance sheet would be multiplied 20 fucking times. This number is so huge, it is outside the existence of our observable universe. There is no way our economy would ever possibly survive if any one of these 5 banking institutions went tits up. And it's because of this shit that they built this entire derivatives market, which is so badly over leveraged that they literally are holding on to a time bomb, clutching it to their chest. They have hugged themselves to a nuclear weapon, and it's sitting in the center, in the heart of our fucking economy. If these guys go down, so does the entire United States currency and entire banking system, all of its economy, everything. Everything that gives the United States value would be worthless. And I'm going to go a little bit further. I want to show you last year's fourth quarter report. This was before the GameStop and AMC situation took place, before our stock market went absolutely through the ceiling, before all of the craziness took place. If you look at these same top 5 institutions, you will notice something that I think you might find pretty interesting. Out of each of these reports for each of these banks, I notice a trend that the only one that actually added assets to match the amount of over leveraging in derivatives that took place was JP Morgan, which added about 300 billion in assets to its total 3 trillion additional derivatives. There's a massive incongruence here. There is something fundamentally wrong with the way that this system is operating. The banks are not holding on to nearly enough collateral to cover any of these derivatives, which, to be fair, it's not all extremely leveraged. Some of it's just very simply interest loan payments on mortgages and things of that nature. But those would still count towards their asset balance sheet, holding on to those properties, having something with intrinsic value. The amount of derivatives that they're holding on to, which are not inherently valuable, except through the debt payments that go through to them, are worth far, far more than any asset on their balance sheet. These numbers should scare every single one of us. Because what this essentially boils down to is the simple fact of what we've all known for years, is that the banks are extremely greedy, they're extremely stupid, and they have been building up a massive portfolio of debt to the tune of hundreds of trillions of dollars for years, even since before the 2008 crisis, and they didn't learn a goddamn thing from it. I don't really know what lesson there is to be learned from this anymore. Because at this point, any attempt to hold them to account results in the death of the dollar, the execution of the entire United States economy and everybody living within it. And of course, the extremely elite, wealthy are going to be just fine because they have access to things that none of us plebes do. They have access to foreign currencies. They have access to derivatives and futures contracts in other foreign markets. They have access to gold and silver and platinum and lithium and any other earth metal that you can think of which has intrinsic value no matter what currency you post it against. And currently, our entire world's economy is operating 99% through fiat currency, which is currency that is backed by nothing. Our currency, just like everybody else's, is fucking paper. And the only value that we assign it is what we say it is. And I find it no coincidence that the amount of derivatives, particularly in the realm of options contracts, has swelled to exorbitant levels in all of these banks' balance sheets. When you compare the charts within these two reports, you will find that since December of 2020, the amount of options contracts through the stock market have swelled to exorbitant levels, disproportionate to all the other banks' assets. Take note that in 2021, throughout each successive quarter since 2020, the number of total options and total swaps that have existed have suddenly completely flipped on their face. That options and futures both grew throughout 2021, especially in the first quarter during the GameStop and AMC squeeze, which went to ridiculous highs and have since fallen off the face of the earth back to their normal levels. The banks are responsible for creating all of these derivatives, and they use it to steal from us. The only thing that really gives any of these devices value is the agreement, the contract, that the money that is owed will be paid on these. But what is happening currently in the economy leads me to believe that we are headed down a path of no return, where there will be no repayment, because there won't be any money from those indebted to provide it. In less than 2 years, the Federal Reserve's balance sheet has more than doubled from $4 trillion all the way up to $9 trillion. In the last 2 years, the year-over-year inflation has swelled from a modest 0.3% up to an astronomical 8.3%. And that wasn't even the high. And they're also underreporting it. And the CPI index is inaccurate. And the actual core interest rate is probably a lot closer to 12 or higher. From October of 2019, the average disposable income for the United States citizen was rated at 7.4% of total net worth, swelled to 26, and then fell back to 5.6. The total percentage savings rate of disposable personal income is completely tanking after a time where the Fed basically just gave us a bunch of free money that we didn't know what to do with. We threw it into the stock market, which promptly took it from more than 50% of us, because it was rigged against us by the banks who were over-leveraged, who were using derivatives to continuously take money from us from both ends with our investments and from our mortgages, debts, and loans. The 3 years that it took the entire United States housing market to become over-leveraged from 2004 to 2007, we managed to accomplish in less than a year. And now our median housing price is selling somewhere between $430,000 to $500,000 for your average home. And despite the fact that the entire housing supply rated in months of supply has ballooned from a admittedly low 3-month level all the way to an astronomical 9-month level in April of 2022, we're still somehow low on houses. We still don't have enough houses in inventory, and the prices of homes are still going to go up, so you better buy now. Sure. With what fucking capital? You took it all. I'm not entirely sure where to conclude this video. I guess it's just to say that, once again, whether it was because we were poorly educated, not paying attention, or simply because we were just bamboozled by an apathetic and malignant government, which is paid off by hostile and malicious banks and lending institutions, we found ourselves at the precipice of yet another global financial crisis, one which is probably going to forever reset our concept of what fiat currency is. It is probably going to result in the death of the United States as an economic power. It's certainly going to result in the death of our currency as the Federal Reserve currency once this thing finally blows up in our face. I don't know when it's going to blow up in our face, but I do know that it will, because building debt upon debt upon debt upon debt will absolutely never work. It is a totally illogical idea. But right now seems like a pretty good time for it to happen. We experienced the worst pandemic since 1917, which affected us on a global scale. It has completely decimated the economies of ourselves and all of our allies, and even some of our enemies or rivals within the geopolitical space. In order to stimulate our economy, we printed dollars, handed them out to all the banks and all of the individuals who promptly were taken advantage of, and now everybody is going to have to start paying a new kind of tax through inflation, which is at record highs, at a time when the Federal Reserve is incapable and totally unable to help us, because they're not going to be able to print any more money. They are not going to be able to control inflation, and the banks are absolutely not going to let up on their malicious lending standards in order to hold up their profit margins. Inevitably, something is going to give, and the levee is going to break, and it's going to crash the stock market. If at this point, after watching this entire video, which thank you, by the way, for watching it this far, I know it was long, but if you do not believe at this point that the entire stock market is about to crash, and you are somehow under the impression that quantitative easing is going to come back and that inflation is going to magically come under control, and that somehow the prices of gasoline and everything else is going to come down, and the dollar will survive, and everything will be star-spangled awesome within the good old United States, you're fucking delusional. And I'm sorry to say that. But we have been pushed to the edge. Economically, our nation can go no further. The average consumer can go no further. We can't afford our own homes. We can't afford our own debts. We can't even afford gasoline or fucking bread. Things have gotten entirely out of control. And the only people who are profiting are banks and elite wealth, which are able to access more options for generating said wealth through other currencies and other precious metals and materials, which make money irrelevant to them. Meanwhile, we have to be stuck with whatever system is put in front of us because we are powerless to change it as individuals. The only way that I can possibly think of that we can take advantage of this situation is to try to protect ourselves. Because the one thing that we know for sure is that there is no way that the stock market is going to survive what is to come. We've already broken through all of the levels of support that I marked out months ago. I knew that the institutions were going to sell out from under us, that they were going to pump and rally the stock market so that they could get out of their positions. And I knew that the fear was going to spread. And I knew that the Fed was going to try and reduce all the fears of a recession, and that Janet Yellen was going to spin her bullshit in front of Congress as she always does. And we're about to go through another rally, which, sure enough, the mainstream media is going to tell you the market has bottomed and we're going to be fine. Don't believe it for a second. Not financial advice. I'm not a financial advisor, but I'm also not stupid. I see the writing on the wall, just like all of the other economists. Even Peter Schiff, who I hate his guts, I agree with him that we are totally fucked. Even I can agree with him on that. There's no shortage of problems which we are about to face, not just as a country, but as a global economy. Things are about to get entirely wildly out of control, and it is our fault for not doing something about it, not educating ourselves to an extent. But more than anyone, I blame our politicians, and I blame the short-sighted wealthy elite for putting us in this situation because of their attachment to greed and the concept that money and the accumulation of fucking inked paper is more important to them, that numbers on a screen mean more than human life. And on it goes. This carousel of insanity that we live on. As Dr. Michael J. Burry said, watching this crash is like watching a plane crash. It hurts, it's not fun, and I'm not smiling. I wish I could be wrong about this, but deep within, I know that I'm not. And even if the market rallies tomorrow, next week, or for the next fucking month, I know that it's just an illusion and it's not going to last. So this is my attempt to reach out to everybody who is investing based on furu advice and the stock market gurus and everybody who claims to know where the ups and downs are, because nobody does. I don't either. But I know that we haven't reached the bottom yet. And if you're buying into crypto right now, thinking that we've hit the bottom, I really feel sorry for you. If you're buying into ETFs right now with your 401k, thinking that you're going to make it big in the stock market over the next 10 years, I feel sorry for you. If you're hedging yourselves with treasury bonds, thinking that the dollar will save you and that inflation-protected bonds will save you, I feel sorry for you. Right now, I think the only thing that will actually save us is to do the exact same thing that all the institutions did to us, and that is to literally short everything that they own. And I'm starting with all the banks. JP Morgan Chase, Goldman Sachs, Citibank, Wells Fargo, and Bank of America. All of them are supremely overleveraged, and all of them are, in one way or another, responsible for the situation in which our economy has found itself, either through neglect, incompetence, or sheer stupidity. I'm sorry for what's about to happen to us, and I'm sorry for where this is going to lead our country and where it's going to lead our planet and how it's going to reshape everything about society. I'm not looking forward to this. And for once in my life, no matter how secure I am monetarily, I'm really fucking scared. I don't know what to do for sure. I don't know where to go from here. But I do know that when this shit hits the fan, and this bomb blows up in our faces, that I am going to personally hold to account everybody who I know is responsible, starting with all of those motherfuckers on Wall Street that are sitting there smug in their glass offices thinking that they're fucking untouchable. I hope everybody else will see it too. And I hope that when we're left with no alternative, that we finally actually fucking do something about it. God, I pray we do. Thank you so much for watching this video. And if you share my feelings and my fears, I would ask that you share this message on social media with everybody that you know in order to warn people. Because what is coming for all of us, no matter what your balance sheet says and no matter what your budget is. Get ready.